Stock market. First of all, let's talk about why we need to invest. So the first point is to fight inflation. By investing, one can deal better with the inevitable that is the growing cost of living. The second important reason is to create wealth. By investing, one can aim to have a better corpus by the end of the defined time period. The third important reason is to meet life's financial aspiration. Now, comes the question. Which asset class should we invest? An asset class is a category of investment with particular risk and return characteristics that suits the individual's risk and return temperament. The following are some of the popular asset classes: fixed income instruments, equity, real estate, and commodities. What are fixed income instruments? These are investable instruments with minimal risk to the principal. The return is paid as an interest to the investor based on the particular fixed income instrument. The interest paid could be quarterly, semi-annual, or annual intervals. In this instrument, at the end of the term of deposit, also known as maturity period, the capital is returned to the investor. Types of fixed income investment. There are 4 types of fixed income deposits. Fixed deposits offered by banks. Bonds issued by the Government of India. Bonds issued by government-related agencies such as HUDCO, NHAI, etc. Bonds issued by corporates. As of June 2014, the typical return from a fixed income instrument varies between 8% and 11%. So the next topic we are going to discuss is equity. Investment in equities involves buying shares of publicly listed companies. The shares are traded on the Bombay Stock Exchange, BSE, and the National Stock Exchange, NSE. When an investor invests in equity, unlike a fixed income instrument, there is no capital guarantee. The returns from equity investment can be handsome. Indian equities have generated returns close to 14% to 15% CAGR, compound annual growth rate, over the past 15 years. Taxation on equity investments held for more than 365 days is taxed at 10%, if the gains are more than 1 lakh rupees starting from the 1st of April 2018. Previously such investments were tax-free. Real estate investment involves transacting, buying and selling, commercial and non-commercial land. There are 2 income sources from real estate investments, namely, rental income, and capital appreciation of the investment amount. The cash outlay in real estate investment is usually quite large, and there is no official metric to measure the returns generated by real estate. The transaction procedure can be quite complex, involving legal verification of document. Commodity, bullion. Investments in gold and silver are considered one of the most popular investment avenues. Gold and silver have appreciated over a long-term period, and investments in these metals have yielded a CAGR return of approximately 8% over the last 20 years. Investment can be done in the form of jewelry or exchange-traded fund, ETF. Key takeaways on investment. Investments optimally should have a strong mix of all asset classes. It is smart to diversify your investment among the various asset classes. The technique of allocating money across assets classes is termed as asset allocation. For instance, a young professional may take a higher amount of risk given his age and years of investment available to him. Typically, investors should allocate around 70% of their investable amount in equity, 20% in precious metals, and the rest in fixed income investments. Alongside the same rationale, a retired person could invest 80% of his saving in fixed income, 10% in equity markets, and 10% in precious metals. The ratio in which one allocates investments across asset classes depends on the investor's risk appetite. What is the stock market? The way we go to the neighborhood kirana store or a supermarket to shop for our daily needs. Similarly, we go to the stock market to shop, read as transact, for equity investments. The stock market is where everyone who wants to transact in shares goes to. Transact, in simple terms, means buying and selling. The main purpose of the stock market is to help you facilitate your transactions. It exists in electronic form. You access the market electronically from your computer and go about conducting your transactions, buying and selling of shares. The regulator. In India, the stock market regulator is called the Securities and Exchange Board of India, often referred to as SEBI. The objective of SEBI is to promote the development of stock exchanges, protect the interest of retail investors, and regulate market participants and financial intermediaries' activities. Duties of SEBI. To make stock exchanges, BSE and NSE, conducts its business fairly. To check whether stockbrokers and sub-brokers conduct their business fairly. To check whether participants don't get involved in unfair practices. To check whether the corporates don't use the markets to unduly benefit themselves. Example, Satom Computers. Protecting small retail investors' interests. To avoid large investors with huge cash pile manipulate the markets and also in the overall development of markets.